All right, guys. Well, happy Monday. Happy first full week of the new year. I think our 2 weeks of chilling are probably over, and it's going to be I think a pretty hectic week here for us. So I'm sure we're all ready to get after it and get 2026 off to a good start. Um, so it wouldn't be the presidency of Donald Trump if there wasn't action. Um, and we had some action over the weekend with the president of Venezuela being arrested. And that is a major potential market mover. And I want to get some dialogue going with you guys on that topic and get some feedback and see what some opinions are. So I'm going to ask you guys some questions like I like to do. So, generally speaking, if there is geopolitical turbulence in an area where there's oil produced, does that typically cause oil production to increase or decrease? So let me give you an example. Okay, so 2003 Iraq War. Okay, would oil production increase or decrease if there was a conflict in Iraq? What do you remember back that long ago? Okay, and so Susan is with the right answer. So it would typically cause oil production to decrease. Okay, decreased oil production would limit oil supply. If there's less supply, demand increases and oil prices go up. So if you remember, if you've been on our calls for most of this year, when there was some conflict between Israel and Iran last year and earlier this year, we were fearful that if that disrupted the supply of oil, that could cause a supply and demand imbalance, that could cause oil prices to go up. Okay. Oil prices going up does what to inflation? Increases or decreases inflation? It increases inflation because it increases the cost of goods and services. So historically, when there's been any geopolitical turbulence in an area where there was oil production, production goes down, supply goes down, cost of oil goes up, cost of energy goes up, interest rates go up, right? And we were fearful of that. Thankfully, it didn't happen. That was pretty quick earlier this year. What we're looking at now is likely the opposite. So we go into Venezuela, we take out the dictator. Um, the next week or two, I think, will be really important, but Venezuelan oil production is significantly off levels that it saw 20, 25 years ago. And so if Venezuela ramps up oil production, like if you looked at the stock market futures over the weekend of like all the US oil companies, Chevron, ExxonMobil, they were all up 8 to 10% in pre-market trading on the expectation that they're probably getting into Venezuela, they're capturing market share. That market, which was a big market for them 20, 25 years ago, might come back online. And so Venezuela has massive oil reserves, and if oil production increases, supply increases, now prices come down. And so oil futures came down today and over the weekend, lowest level they've been in 4 years. And so this situation's a little bit different because this could be a move that increases, doesn't decrease oil production. And so I think the next 2 weeks are going to be really important to see um, what kind of transition government they put in place. Is there continued strife and fighting, or do they put someone in, they can get oil production online and ramped back up? And if that's the case, that is probably good news for interest rates as a whole. So it's interesting how a dictator in a foreign country being removed can positively impact the real estate market in the United States, which just shows kind of how interconnected global economies are right now. Um, it's not going to be an overnight turn, but we talked a lot about earlier this year or I guess last year now, when Trump took office, he really focused on um, increased energy production, decreased energy prices as a way to bring inflation down. If you guys remember what we talked about
A minute.
last um, any president Donald Trump, Joe Biden, whoever, what's their biggest priority in their midterm year? It's reelection. And right, most politicians in general are probably more focused on reelection than anything. How can Trump benefit Republicans in the midterm elections, reelection? He can do it by bringing energy costs down, bringing inflation down. People are more likely to vote for him and his party if energy costs are down. So it'll be something interesting for us to watch. Um, but if Venezuelan oil production increases, it's a good thing for um, global economy, yes, but also directly impacting us from an affordability standpoint for with our customers. So will be something very, very interesting to watch. Watch oil futures and watch the stock prices of oil companies. The other piece of the equation, the oil that is produced in Venezuela is like they call it dark crude, and it's oil that has to be refined. Does anybody know where some of the largest oil refineries are in the Western Hemisphere?
I
I
know.
saw you unmute yourself, Brett.
Louisiana.
Down in the bayou.
Texas and Louisiana. Okay, so Texas and Louisiana's local economies could be very positively affected by this. And so if I'm a real estate agent and none of us are in Texas, like Southeast Texas, Houston, Louisiana, that's probably a positive for the real estate market. So again, just an interesting dynamic that how things are so interconnected here globally. Um, so on the home front, what do we think will happen with interest rates this week? I think it'll cause interest rates to drift a little bit lower. The next 2 or 3 days, I think, will be dominated by headlines out of Venezuela and what does that look like, and is there stability, and is it kind of a peaceful transition, and what kind of government, short term can they put in before there's elections, and what happens with oil production? That'll certainly be a market mover this week. At the end of the week, and Aaron posted this in the chat, that economic data continues to roll in. Monthly jobs report comes out this Friday. So the December jobs report's released, and that'll certainly be a market mover as well. I'm going to share my screen because we used an analogy a couple weeks ago that I just wanted to show you kind of how it's playing out. So if you guys remember a few weeks back, we used an analogy of a rubber band and a rubber band being pulled tighter and tighter and tighter and tighter. And at some point, when it gets pulled far enough apart, it pops, right? And if we look at the bond market for the past 6 months, the bond market has been trading in a very flat pattern. Bond prices a little bit up, a little bit down, just kind of ebbing and flowing in this tight range here between 98.5 and like 100.08 or oh 05. That's a really tight window. It's about 0.3% difference in interest rates. We've seen rates drifting up and down, ebbing and flowing. The longer we stay in that really tight window, the tighter that rubber band gets, the more likely it is to pop. And you can see how unusual it is for rates to really be in that tight of a window. Let's go back over the past couple years. Really tight window here, but look at the massive ebbs and flows from this was January of 2024. Bond market sold off, then rallied, sold off, then rallied. Big up and down swings here for 2 years until the last 3 or 4 months, and rates have been very, very narrowly moving. So we're going to have a breakout at some point. That rubber band analogy is going to pop. Um, any big economic news that we have, what's happening in Venezuela, the Friday jobs report. Later this month, we get another Fed meeting that's on January 28th. All of those things are data points that will stretch that rubber band, and ultimately it'll pop and rates will break out and move one way or the other. We think that the signs continue to point that when that does burst, rates will probably improve and probably bust through these what we call resistance levels, and rates will continue drifting lower of when that happens. But for the next 30 days, you've got the situation in Venezuela. We have a jobs report. We'll get more inflation data. The inflation data from December was very positive and very tame, but also not really trusted because the data was compiled during the government shutdown. So The jobs report this week, inflation reports over the next few leading into the Fed meeting. We probably have a breakout coming at some point. Um, and then kind of the other X factor is, when does President Trump announce his pick for the replacement of Fed Chair Powell? That could happen this month. Really never know when that's going to happen. But a lot of forces that are moving rates around. Thankfully for most of us, most of the news will tend to continue moving us in a positive direction. Um, Here's the Fed Watch, the CME tool. I pull this up. Very, very low probability. So 87% chance that rates stay the same. Fed doesn't cut this month. So very small probability that the Fed makes any meaningful changes. But something for us to watch over the next few weeks is, what does that percentage do as economic data rolls in? But again, Venezuela for the next couple of days, jobs report on Friday. We think most of that news this week will be positive, and you'll see rates continuing to inch lower at a slight pace. Um, I've got a couple other charts that I found that I wanted to share with you guys. As always, whoever you work with on our team at Cross Country, if you want either of these, just message us. We'll get them in your hands. So the locked-in effect, which has been, really a big headwind in our face the last couple of years. People that have a very, very low mortgage rate from 2020 and 2021 have been really unwilling and unlikely to move over the past couple of years. That's shifting for two reasons. One is time. The longer someone owns the home, the closer they are to selling and moving out of it. The second piece of that is interest rates. The percentage of people that have higher rates continues to go up. And you can see the blue line here. Those are the people that have sub 3% mortgages, which was basically zero for many, many years. It spiked during COVID, peaked at 24% of all mortgage holders. That's down around 20. And then the people with greater than 6% mortgages actually crossed and exceeds the people with less than 3% mortgages. So fewer and fewer people as a percentage of the overall home ownership pool have those sub 3% mortgages. Now, are there still lots of people in the fours? Absolutely, right? Are there some people in the fives? Definitely. But going from 4.5 to 5.99 isn't as big of a pain point as going from 2.75 to 7%. So that gap is shrinking, and that's a positive. Um, at the same time we're seeing that, I think that's moving the needle in a positive direction with home sales. And you're starting to see, and this is like ever so slightly, but for the past few months, you're seeing an ever so slight small improvement in pending home sales. So these are contracts that are written. You typically don't see that at the end of the year. And I know, talking to our team and realtors that we work with, December was a pretty strong month for most people. January out the gate in 2026 for many people is a pretty strong month. And I think that's because the end of last year was better than the end of 2024. It was better than the end of 2023. The beginning of 2026 seems to be on a better pace than the beginning of 2025 and the beginning of 2024. And you can kind of see the data here, the pending home sales. So we're about back to where we were in 2003. And that was really after the big decrease in home sales in 2021, 22, kind of started to bottom out in 2023, and then just kind of drifted flat to slightly lower. So some positive signs there as well. How are we and our team using this? So I think we've talked about this some on these calls, but there's a lot of clients, a lot of buyers that we've all been in contact with over the past few years that haven't purchased a home for whatever reason, likely affordability. Um, Affordability should continue to improve as rates drift lower, but competition will likely increase as well. Both the seasonality of the spring and summer buying season that will start to approach here, and lower interest rates will pull people off the sidelines. So our team's sharing this data with people, not as a way, you can't like push people off the fence. You can't make them buy a house when they don't want to, but certainly we can educate people on the current state of the market. And I think an upward trajectory of pending home sales shows an improving real estate market. an improving real estate market is great, certainly great for sellers, not as good for buyers if it increases competition and increases the likelihood of multiple offers or maybe pushes prices a little bit higher. So we've been saying this really since the second half of last year. The first and or second quarter of this year is probably the sweet spot. If you're trying to call a bottom, like what's the perfect time to buy a house? Like we could probably put our flag in the sand today and say it's about right now. Um, and I think we all have customers that probably regret not taking action. Look back, let's say, you've been in the real estate or mortgage business 20 years. You could probably pick times on the calendar over that period of time and say, I had people who missed out here and missed out here and missed out here. Like certainly like post '08, a lot of people missed out and didn't buy when there were great opportunities. There will absolutely be people that will miss a great opportunity in the first and second quarters of this year if they wait too long for the kind of air quotes perfect time to buy. We kind of think the perfect time to buy is like we're in it right now. And it'll be less favorable for a buyer over the next few months as competition ramps up. Um, Okay, so I wanted to go through one other thing with you guys, and these are kind of more of a scripting thing, just some of the things that we're saying to try to get people off the fence. Um, so we talked last week about this week, next week are great times to reconnect with people we had had conversations with over the past year or two that didn't take action. But like what you say to them, I think is important to try to peel back the layers of the onion. So when we're calling those people and or following up with text messages, but really it's a phone call first, I think. The main question we like to ask is, I know you didn't buy last year. Like, what was the main reason, or what kept you from purchasing last year? And then follow it up with what you looking for to get back in the market this year. So kind of find a fact finding of what prevented them last year, what would have to happen for them to purchase this year. And I think that's just a great way to get some discussion points going. And then sharing data like this to really educate people on what's happening in the market. Um, okay, I'm going to jump back to the chart here, and then I think we'll get you guys off here a little bit early today. So you can see the bond market's up 11 basis points today. That's a slight improvement. Is it something for us to celebrate as a major market movement? No. We're really just regaining ground we lost last Wednesday and Thursday. So this news out of Venezuela isn't really market shaping just yet. It's just kind of like slightly turning the battleship, if you will, in a positive direction. But throughout the week, what happens this week, what happens on Friday, we'll probably see some improvements and start testing some of these levels. So we're still stuck in that really tight kind of trading line of interest rates. But again, every bit of positive news is good for us. There was a couple questions I saw here, and so I just wanted to answer those real quick. So let me stop my share and jump into the chat. So we had a question. I think that was just someone commenting that we'd have a new Fed chair getting announced. So seasonal employment affect the jobs report. So Linda, your question. So how does seasonal employment affect the jobs report? So the BLS, the Bureau of Labor Statistics, they adjust the jobs numbers based upon seasonality. So when is the biggest surge in seasonal employment? It's typically November and December because of retail around the holiday season. That's factored into the reports. A seasonal increase in November, December hiring doesn't make a jobs report or an unemployment rate look better than it would be for the short term. That's factored in. So it's expected that employment will surge a little bit and then decline in January after the holidays. That's normal. They build that in. There's seasonal adjustments. Um, the other question, and I think that was yours, Allegra, what are interest rates? Where are we seeing rates? It depends on program. So the average conventional, so Fannie Mae, Freddie Mac, 30-year fixed rate mortgage is somewhere in the low to mid sixes, 6.1 to 6.4 in that range, ebbing and flowing day to day, depending upon the market and someone's FICO score and if they're buying the rate down. I would put 15-year loans about a 0.5% below that. So you're probably in the mid to upper fives. Again, kind of same factors that can influence things. Government loans are a little bit better typically than a conventional. So, if you subtract an eighth to a quarter of a percent, sometimes maybe a little more for an FHA or VA loan, you'll see some differences there. Um, Oddly enough, jumbo rates are actually really attractive right now. So if you work in that space, a little bit higher price point, those are as better or as good, maybe even slightly better than conventional in some cases. Um, and then we do a lot of non-QM, and we want to continue talking about that in classes. So 1099 programs, bank statement loans, DSCRs, typically 0.5% or so higher than a conventional. So a bank statement could be in the upper sixes if a regular 30-year fixed conventional is in the low to mid sixes. So maybe a 0.5% difference in rate there. Um, all right, I think I've got all the questions, guys. So we will let you off a couple minutes early today. Have a great day. Have a great week. Have a great start to the new year. And we will see you guys next Monday. Thanks, everybody.